questions today, and just make sure the chats are coming in today. So if you're out there asking any questions, I would love to answer. So today I want to do a recap of. So if I could ask, you guys are coming up please, on here. If you can see my screen, I'm just going to do a test here. Hey, Mr. Rogers, it is not coming up again, and I can see you. So I got some of you guys on the side screen. I have no idea what's going on, but they aren't showing up in my chat button here. But I will answer these on a side note in regards to another section. Hey, I see Mr. Rogers on here. So if you guys would post comments on the one channel, and I'll be answering those questions because I have you live on another screen that I have here. So, okay, without further ado, thanks for coming in, guys. I'm sorry about all the technology mess. It's like a phone, you just want to, do that to the phone and hit there, and you talk to the other person. I shouldn't need to come in here and program this thing. So without further ado, let's get over what's happening in the markets today, because that's why you're here. So let's go over to this section here. And I can't do it this way. Hold on one second. Well, if you got any questions, I'm going to go to that tab here in a second. So, okay, here's what's happening in the markets today. So if you're out there, pay attention, because there's really not that much news. The 10-year Treasury just spiked up a little bit, but look at it. It's only up 0.015. So, that's nothing. Okay, I'll just leave it at that. Nothing. The MBS is nothing. MBS is nothing. There's nothing going on today, guys, and I love it. Okay, I love it because it's so hard when the markets are up 500 and mortgage rates go up 25% one day and then up 0.5% the next day and down and so forth. So let's get over to some good news that we have in the headlines, and then I'm going to go over and answer any questions that you guys have. Okay, so one of the things that just came out, you can see it right here at 3:17 p.m. So this is hot off the presses, folks. Rent growth drops back to pre-pandemic levels, but some markets are falling much harder. Okay, so let's break down this. But the good news here is for those out there with housing issues. If you have a problem with, you can't afford housing anymore, even rents were getting out of whack. So what can be done? Well, unfortunately, we're starting to see rents come back down. What's their normal growth rate? Let's see what here. Stocks closed lower, NASDAQ drops second day, highest yields, press tech names. Drop a second day as high yield suppress tech names. Okay, so we'll discuss that in a little bit. You can see right here through apartment rents have increased slightly for the past few months as seasonally strong spring activity kicks in. But in March, they were up only 2.6% from the year earlier. That's the smallest read since April of 2021, where the average is about 2.8%, and we saw much bigger growth than that. So that's one piece of the inflation component that's out there that we're going to start seeing that down. So we have shelter in general. That's people buying houses and people renting. Those numbers are starting to come back down dramatically. So that's going to help inflation a ton. We're going to look at oil prices here and some other things so we can get a beat on the market and what's going on with inflation. But you're seeing right here that rents are starting to come down, giving a little bit of savior for people out there that are renting. The next piece of this puzzle is I want to go through the economic calendar with you guys for today and what's happening basically today and tomorrow. Let's go down through here. I want to show you guys what I do. So what I do is I go to Bloomberg. Okay, I'm teaching you guys how to fish. I'm going to Bloomberg calendar. You go down through here and you hit the filter. Okay, so this is what I do. This is how I provide you guys the information that's up to date. I go over here, I pick United States. I want to select all the categories, and then I want to choose only the top tiered comments. So when we go down through here, you're going to see consumer confidence came in today, and it came in higher than expected, higher than economists expected. I have no idea who they're surveying because in this market right now, I'm concerned about flu, COVID, inflation, recession, bank failures, and the list goes on and on and on. So if you're out there and you're confident about the economy in your life, God bless you, man. Tomorrow we have pending home sales. They're coming out in crude oil inventories. This is going to give us a beat on where oil is. Is oil starting to come down? Is there ample supply? Is that going to help us on the inflation front? So that's what we're going to watch through the rest of the week. But two big items are coming out later in this week. Thursday, we have the GDP, and that's going to show us is there growth in the economy. Because what's that old-fashioned definition of a recession? Basically, it's 2 consecutive quarters of negative GDP. Well, we had that last year, and everybody says, no, we're not in a recession. So did they change the definition? Or if that's still the case, we might see a recession on the horizon. Everybody and their mother is predicting that. Another section here is the initial jobless claims. They're expected to go up. And everybody, again, economists, Wall Street, and everybody's predicting a recession within the next few months. So this is an area we're going to pay attention to because you're going to probably start seeing those raise. And then the core PCE, this is the inflation number that the Federal Reserve most monitors, and it is coming in on Friday, and I'm going to expect what that's going to be, but that's going to play a huge role in what the markets are doing. So the next piece of this puzzle is what I want to talk to you guys about is, well, that was my bond recovery this morning. What is going on in mainstream media? So you see right across here, the indexes, the S&P 500, the Dow Jones, the Nasdaq, and the Russell are basically all. I'm going to say the Dow Jones is down 92, but let's just go across the board. And this is doing nothing, folks. How often do we come on here and it's up 400 points? We have gold up or crude oil up a little bit, but it's still on a bearish run right here. Fed's bar sees need for stronger bank regulations. Well, then do something about it. And you go down through here, and let's see what the other rest of the comments are. U.S. lawmakers grill regulators in Senate hearing addressing the bank failure. I'm going to watch that in detail tonight so I can come back to you guys and give you kind of an idea what I'm expecting there. And then here it is, guys. A recession in 2023 is now inevitable. Layoffs in tech and financial will spread to other sectors. So that's what the markets are predicting. That's what economists are predicting. And now Wall Street's predicting that as well. So we're going to talk about recession, housing, and everything else. Well, other piece of the puzzle that we got today alone, is the Case-Shiller Index. It gives us what is happening with house prices. Okay, so not house sales, but the prices of home. Home prices cooling in January, even falling in some cities, the S&P Case-Shiller Index says. And you can see right here, the biggest areas that are falling are Seattle, San Francisco, and San Diego. So please pay attention when you're watching mainstream media and other entities doing this. If they're picking out, San Francisco and San Diego and making that a point to say, see, the markets are crashing all over the board. Well, they basically picked the top two areas in the whole entire country to choose. So maybe let's choose anybody but those. And what is happening to prices basically across the board there? Well, the highlights of the day is home prices drop year over year for the first time since housing bust number one. So that was housing 2008, and there was a huge reason for that. It was just unbelievably terrible quality loans. Okay, that is basically what comprised of home bust number one. Now, we don't have that in today's market. What we see is we had too much money flowing into the system. And guys, we learned economics 101 the other day. Remember, I just showed you the supply-demand chart. Why did we have prices of homes skyrocket? There was a limited supply, and there was everybody and their mother wanted to buy a house in 2020. So they did. They had the money to do so. There was programs out there, and mortgage rates were the lowest in history. So they started accumulating homes. Okay, so let's see how bad the market is doing right now. So year over year, what it's saying in 2023 is the housing market is flat. Where's that crash? Didn't we expect like a 20, 30? Some even YouTubers are out there saying that's going to drop 40%. Well, they've been saying that for the last couple years. Let's say back in 2020, they missed this appreciation, well, that appreciation, and then on top of that appreciation, and they've been saying there's going to be a crash the whole time. So we're up 25% on average in 2021. Houses were up about 18% in 2022. So if you combine that together, house values are way up there, folks. So if we had a contraction, we're still above, and there's still tons and tons of home equity out there. Doesn't mean the new home buyer is getting a good deal right now, but it's showing you that we're not seeing a market crash just yet. Okay, so what happens? We know that the federals or everybody's saying that there is a recession on the horizon, which you're seeing right here. What normally happens when we see a recession? Well, over the past 5 recessions, what's happened? Mortgage rates have fallen on an average of 1.8%. So this is when I keep telling people, okay, hold off, guys. If you love that house right now and you really need to get in it, you're probably, I'm not guaranteeing this, but 5 out of the last 5 recessions, we had mortgage rates on average drop 1.8%. Okay. I'm not saying it's going to happen this time. I'm not saying we're going to see a full 1.8%. We're going to see reductions, and even the federal futures index is telling us the Federal Reserve is most likely going to pivot at their June or July meeting. Okay, so that's great news for those out there that are looking to get a mortgage. The next piece of this puzzle is let's look at the markets right now, what they're doing. But what I'm trying to do on this is to show you guys what happened with this banking fear. Okay, so if you watch my morning video, it's kind of a recap of what I'm doing in the mornings, but I want you guys to be able to ask questions, and I'm going to get there in a second. Okay, and if you're on here, please let me know where you're coming from, and then give me your. Also, if you don't let me know where you're coming from. Let me know what you do. Are you a student? Are you a realtor? Are you in the mortgage business? Are you a consumer? What do you do out there? Please, give us your context. I'd love to get those questions answered. But over here, what I started tracking is when these bank stocks really started to crater. If you start doing a lot of your research, you're like, okay, this is odd. This is really odd. In this morning's video, I explained to you guys how bonds work. And basically, here's in a nutshell. And I'll recap it real quick for those that haven't watched this morning's video. What's happening? Let me give you this analogy. If I wanted to, I had a newborn and I'm like, okay, I know in 17, 18 years that the newborn's going to go to college. So I'm going to buy a bunch of treasury bills right now. So at maturity in 15 years, I'll buy a 10-year or 20-year note. After that duration of time, I'll have enough money to put my child through college. So what I do is I go out there and buy all these treasuries because they're 100% guaranteed by the government. And what happens is, let's just say in its simplest terms, I spend right now, I give somebody, I need $100,000 at the time where my child goes to college. So right now I'm looking, I'll put in 50 grand. So over the next 10 years or so, that'll double because that's the coupon rate of the bond. So I'm putting in 50,000 now, it'll double. And then, 15 years from now, I'll have $100,000 that I can put, cash those bonds in and put my child through college. Well, we find out that my child, and of course my child is a stinking genius, just a genius. So at age 10, he or she gets admitted to college. Okay. So now I'm like, oh crap, I need money to put my child through college. So I take these bonds and I'm like, okay, I'll cash them in so I can pay for college. Well, unfortunately, those bonds are still only worth 50 grand because I didn't hold them to maturity. Because remember, after 15 years, I can cash them in and double my money. Well, now my child's going to school now. So I need to cash those in now. Well, they're not worth the $100,000. They're only worth $50,000. That's what I paid for them. Okay. When you start looking at the markets, when you start looking at what's happening to banks, that's exactly what they did. They took their assets. They need to have X amount in reserves. So they went out and bought treasuries because they're 100% secure. Okay. But what's happening now is they're saying, well, if you mark them to market what they're priced at today, you're insolvent. You don't have enough money. Well, that would be the same thing as if you were in the same position. You needed that money prematurely because your child was a stinking genius like mine. And you needed the money to put them to college, but you need to hold that bond to maturity so it's worth its full value. That's what's going on, folks. So, it would create problems with all kind of banks, but unless there's a run on the bank, there shouldn't be any issues. Well, what happened is somebody from Sun Valley Bank or Silicon Valley Bank tweeted that they're going to take all their money out of the bank. Why would you do that? Okay, that's the first question I have. And that's what everybody should be asking. Then how did regulators get through this? And how did this happen? And everything else happen? There's so many questions, and there's so many banks out there. You got to realize 2 or 3 or 4 failing because of bad management and other things, it's going to happen. It's like companies. If you went and just look at how many companies go bankrupt every day, you'd be astonished. But back in 2008, we had over 400 banks go under. So if you really study this, we are nowhere near, not even close, not scratching the surface of where we were back in 2008. Make sure you do your studies on that stuff. Okay, so what I was doing here, I'll get back to this. What I was doing here is I was starting to track all these bank stocks that were just getting hammered, and just to show you guys how they'll probably recover pretty good, maybe all the way back to where they were, because this isn't systemic, meaning it's not going to go all over the country and cause all banks to fail. So when you go through here, here's what's happening in the bank sectors today. So nothing really major, down 0.7%, down 2, First Republic. Okay, they were up big just the other day, but look at their 52-week high and low. $13 is their current price. They were at 173. Okay, and you can go down through here. Really no change, up 0.31, up 22, up 2. And basically they're flat right now. Great. Why? Is because Congress is really pounding the table on this stuff right now. So everybody's halting their trading. As you can see, basically based on Yahoo Finance, the markets aren't really doing anything. They're not even a 0.5% on any of these averages that have been moved for the day. So that's what I wanted to show you. Now, I got some fantastic news for you guys. Okay, so if you're in California, we have a new program coming out. It'll be here next week. It launched yesterday, but we'll have access to this next week. What is it? Well, basically, it's a program that California came up with, and they're going to help you with your down payment assistance program. They'll give you all the money you need for a down payment, up to 20% of the house's value. Okay, so think of it. If you had percent to put down, that's some other people's money. You know how they always say other people's money. So if you had an entity that would come to you and say, okay, we'll give you 20% to buy a house. Okay, why would you not take it? But there are strings attached. I get it, but the strings attached, I would even take this loan. Okay, so let's go through the parameters of this thing so you can understand what it entails. Okay, so the program eligibility is this. Reviewing the guidelines below for both borrower and property requirements to determine if you may be eligible to apply for the Dream for All Shared Appreciation Loan Program. Now, I have an extensive video coming out on Friday morning about this, so check that out. But to be eligible for this program, you need to be a first-time homebuyer. See the definition. Well, first-time homebuyer is either this. This is your first home ever, or it's your first house that you've been put on a deed to in the last 3 years. So if you were a co-signer or you're a co-borrower or something like that on a mortgage, and you've been on there up until now, you don't qualify. Unfortunately, you don't qualify. You cannot be vested in a home over the last 3 years. Okay, so that includes even first-time home buyers. The property must be owner occupied, meaning you have to live there, and you cannot have any non-occupant borrowers on the loan. So many loans, FHA and conventional, you can have mom, dads, aunts, uncles, brothers, sisters, whomever. If you don't qualify for the loan, they can co-sign for you without moving into the property. This one you cannot. Okay, so that's that. I want to make that clear. California borrowers must complete 2 levels of home education. I'm sure you're more than willing to do two or three or four home education classes if you're going to get maybe $100, $200, $300,000. Okay, so what kind of properties can you look for? Well, great question. Must be a single family 1-unit residential building, including approved condos, PUDs. It cannot have guest houses, granny units, in-law apartments, or 2, 3, 4 units and things like that. It has to be a single unit, so a single family home, a single condo, or so forth. You can do this with manufactured homes. And the condominium, if you're looking to buy a condominium, please reach out to us. We got to make sure that condo complex is approved through this system. Okay, so here's how it works. Okay, so if you're part of let's go through here, and I'm going to bring this up big. So what happens is it goes off of your income. So down below in the description, I'm going to add in there this link. And if you're at 80% to 150% of the average median income in California, and I'm going to have every county listed down below, you can check that out. Here's how this works. You should be eligible. Okay, so for example, in this case, you're going to buy a $500,000 home. I know in California that's not even a starter home, but amuse me on this one. You're looking to buy a $500,000 home. So what happens is this grant program is going to give you 20% of a down payment. Okay, for you to use. All right. That's going to be $100,000 that you're going to be granted to you. Okay, so what's the catch? Well, let me get through it. So what's going to happen is that'll be a second lien. It's just going to be money set aside. You don't have payments on that or anything. It just sits there. You owe that money. So now here's the catch, but it's a fantastic catch. 65 years later, you're saying, okay, I want to go out there. I want to sell the house and move into a bigger house. So what can I do? Well, that's great. So in there, you had 140,000 appreciation because remember, we bought it for 500,000. So how that's going to get split up is the down payment assistance program is going to get 20% of the share of the appreciation. That's the shared program in here. Okay. So what you're going to owe back is right here. You're going to owe back $128,000. That is the $28,000 or 20% of the equity that you're sharing. That's how much it appreciated, plus the $100,000 that they originally gave you. Okay. So what does the borrower lend or what does the homeowner get in this? Well, they're going to pay back the first mortgage, $370 at that time, because that would be the amortization of this. So you owed $370. You're going to pay the $128 back for the shared program. The $100,000 that you got plus the $28,000 in shared leaves you with $142,000 in equity. Okay. But let's say, for example, you make less than this. Well, the numbers even get better. So if you're at 80% of the average median income for the areas, and again, the link will be down below, here's how it works. Everything works the same, but you only have to share 15% of the profits. So when it comes over here, you're going to pay back 121,000 because that's the 15% share plus the 100,000 that you got back, leaving you $149,000 in profit to put in your bank. Okay, so that's what's going on today. This is a fantastic program that's coming out. We're going to have availability of it next week. But please, if you're interested in this, I'm going to have a link down below where you can schedule a consultation so we can walk you through this entire process. Let's see where mortgage-backed securities are for today, though. Let's fresh it because this is the last reading. It is down 3, basically nothing. So where rates finishing up today, up 6 basis points. So if you didn't lock in a rate yesterday, your rate's probably going to be just a hair higher than what it was yesterday. I love this because finally we're getting back to some normalcy. Instead of going in here and the rate's 7 today, and tomorrow it's 5.99, and the next day it's 6.25, it drives you crazy. So, with that being said, let me get over to any questions that you guys have. So let me go through this. If you guys would please leave any comments that you have on the channel, and I would love to answer those. It looks like Mr. Rogers is on here, but if you guys would, please put in any comments that you have. Let me put up the chat bot. For some reason, it doesn't look like it's working again. Let me go back through here and see if there's something I did not turn on. Let me go back to this and just put this up. Maybe that'll work. Nope, that ain't working either. And I'm also on my live stream chats, and I don't see any chats over there. So maybe you guys just don't have any questions. If that's the case, let me see if I can post in something here. If it pops up. And if it doesn't, I need to get back with these guys. Here it is. Okay, so the chats are working. So if you guys have any questions out there, please start loading them up, because if you don't have any questions, there's really no need for me to be on here. But you have to have some questions. If you have any questions about stocks, bonds, cryptocurrencies, if you would, just let me know where you're coming from. Where do you live? Are you in California? The goal here is to be able to capture people all over the state, or all over the country, so you guys can ask questions in regards to buying a house, refinancing a house. Do you qualify? How much can you buy a house? How much money does it take? Where are mortgage rates going? What's Bitcoin? I think Bitcoin's a good investment, and all that stuff. I can answer any of the questions that you guys have. But if there are no questions out there, then I will be done for the day. If you have any questions that you think of after you watch this video, please shoot me an email. I'll give you that information right here. My email is pretty simple to read. Yeah, we'll put it up on the screen right now. So if you have any questions or you need my assistance with a mortgage, all I ask you to do is reach me at dan@therateupdate.com. So let's see if there's anything. Oh, Lydia, thank you for coming in. When purchasing a home, will they need to run my credit if I don't work, if they are just going off my spouse's income? It depends on where you live. Some states require that if they're married, both people are on. We at least pull their credit, even if you're not on the loan, for debt ratio purposes. But in most cases, if you're not on the loan and you're in one of the other 48 states that don't really require it, we don't have to pull your credit, but we can't use your income. So let me read that one more time. When purchasing a home, will they need to run my credit if I don't work? No, you don't. You're fine. That's what I usually suggest in most cases. If the spouse isn't working and there's no income there, no disrespect, but my analogy behind it is all that you're doing to the loan application is making it a little bit worse. And what I mean by that is we got to include your debts, but there's no income to offset those debts. So I would highly suggest having your husband apply only and just doing it under him, but you should be fine in that case. Do you think rates will increase in the next week or so? And this is by Rick. So Rick, I have a tough time predicting, but let me just give you all the analysis that I have in the background. Okay, so what I'm seeing now is the Federal Reserve, they're under the microscope. They're increasing rates. I hope you understand that is just inflation. They're trying to resolve this inflation number, but they're doing it way too fast. Okay, a lot of the futures index, and I didn't bring it up today, but I can even bring it up. Let me see if I can bring it on the screen because there's a reason why I'm telling you this. Let's see what we got right here. I'm going to pull up the Chicago Mercantile Exchange. I'll do that on the side right here in 1 second and show you guys probabilities. So let's go over to here. So why I use this chart is because this is one of the primary questions that I get. Dan, what's going on with housing and what's going on with the interest rates? What I can show you, though, is let's go over to this, and this is what I watch. Okay, so this is the federal funds futures. This is what's trading on the Chicago Mercantile Exchange. Yes, you can trade federal funds futures. What this is telling us is right through here. You can see in May, they expect the futures market expects the federal funds rate to be, well, the consensus vote right now is 4.75 to 5%. That's kind of right where we are right now. Okay, we're right on that tune. Could the Fed raise one more time, 25 basis points? Maybe. Okay, maybe. And I don't know. Nobody knows. It might even come out after this banking hearing. We might get some more insight into that. But if you notice through here, look all the way through here. This is telling us the probability going forward in the June meeting is that they're going to stick with the rate right here, and then look, all of a sudden these blue lines, these are the primary, where they think the federal funds rate's going to end up. Do you see that? How it comes down, and then every time it goes down, this is what's happening. The federal funds rate is coming down. So as long as we see the federal funds rate coming down, mortgage rates are probably trickle along with it. But it's a whole different dynamic because mortgage rates are predetermined by the mortgage-backed securities market. It's not the federal funds rate, but they work in a lot of tandem there together. So my expectations are coming June, July. We're going to see the peak of rates. Where they're going to be, I don't know. If there's another big banking issue coming up, you might see rates ease a little bit. If we get a reading maybe Friday's reading on inflation comes back and it says inflation is basically under control, or if it sees inflation kind of skyrocketing, well, then rates are going to go up again. But I think the Federal Reserve is going to be real cautious. And we saw today, rents are going down, house values are going down, lumber prices are going down, copper prices are going down, and oil prices are on a bear skid. So everything is showing me that basically we should be seeing rates within the next 3 to 4 months starting to ease. Okay, long answer, but I apologize about that, but hopefully you get it. Let's see, Lydia, California. Okay, so you should be good. Like I said, I wouldn't add you to the application as well, and that's the way I would go. So hopefully you guys reach out to us for a quote. Love for you to do that because that's what we do for a living. We do mortgages. Okay, so let's get over. I'm going to come into more. Let's see. I think this one. All right, so let's see the first question that we have. Planning to buy a house in 6 months or so. Currently paying about $500 a month for a car. About 30K saved. Should I pay down car to 20 and use 10K to down pay a house to increase buying power? That's a tough question. I would use my money. I would keep that $500 car payment as is. Use any money that I possibly can to buy, put toward the house as much as I possibly can. However, we can do the analysis to say, because if you use $20,000 or $10,000 and use extra to put down, you're not going to really see that much of a savings. So depending on your whole dynamics, how much other bills you have and so forth, but if that's your only bill, I would probably sit on the sidelines right now with that, not prepay it. And once you get pre-approved, hopefully you can reach out to us for a pre-approval. We might tell you that you can qualify for more if you use all your monies to basically pay off your car, pay down your car. Because if you pay it down, you can't prepay the car to eliminate the car payment. You'd have to completely pay it off. And if it's a lease, even if you pay it off, that payment counts. So I would have to look at the whole financials. But in some cases, I'll look at it and say, I would rather use the extra $10,000 to put down on my house or put aside for a rainy day. Because once you get in that house, there might be things that happen. Let's say the furnace or air conditioner goes out, your roof leaks, your refrigerator goes out. You might need those reserve monies. So I'm always a proponent leaving enough money in the bank to cover my debts for about 3 months, so I don't have to worry about things happening down the road. So thank you so much for the question. Next question we got is, would I still be able to be added to the title? Absolutely. Absolutely. So we do this quite a bit where we only use the main or primary wage earner. If there's other wage earner there, we'll put them in. But if there's usually the spouse is not a wage earner, we kind of look at everything and say, well, we don't need you. And again, unless it's a state that you're required to do this. But if you're not required to do it, I wouldn't suggest you. You should be fine. And again, reach out to us. I would love to help in any way that we can for you to get into that new property. So that should look like it. We might be on in and out of here within a half hour. So if you guys have any more comments, please let me know. I apologize about yesterday's video. I was all over the map. It was a Monday. That's my only excuse for yesterday. I had one of those Mondays on a Monday. And it was just terrible. So I wasn't prepared. It was my fault. And I greatly appreciate you guys watching through it. So please make sure that you check my channel out. You go over watch my morning videos. I try to give you a caption of what all the markets are doing within like 10 minutes. and that's what I do. And I come on here on a daily basis just so you guys can ask questions when it comes to real estate. Remember, I do another show tomorrow, Wednesday evenings, from 8 Eastern to about 10 Eastern time, and it's basically home buying. If you're looking to buy a house, we answer all your questions there. But on this channel, what I try to do is I want to educate those out there that have finance questions. I don't care if it's the stock market. If you're a teenager, like, what's the stock market? What is it? I'll explain it to you. I can give you the backdrop of Bitcoin and all this other stuff because I want you to tap into my knowledge so I can share it with you so you don't make the same mistakes I made in my life. So God bless, guys. Thank you so much for watching. Hope you find value in this channel, and I will see